Bismillahirrahmanirrahim. Assalamu alaikum. Good evening, everybody. Yesterday we started the topic of the consolidation, and yesterday we covered IFRS 10, and thereafter we started concepts from International Financial Reporting Standard 3, and we covered few areas. Like we started with the statement of financial position, where we revised some basic concepts. Of course, these are not very difficult, and when we talk about them, of course, we can recall what we learned during our studies. And if someone is practically involved in the consolidation, he can recall all these steps very easily. So the same way we will continue with some basic concepts, and then we will be moving to more complex areas today. Of course, the nature of the topic is that a lot of numerical work is involved. So I would request you people to have calculator and notebook ready so that you could do calculations alongside me, and this will of course benefit you. A recording of these sessions will be available. All other sessions are now available on YouTube. You can search for ACCA Pakistan on YouTube, and you will find all the latest videos uploaded by the ACCA team. And all the sessions till tomorrow have been uploaded on the YouTube, our YouTube channel. And of course, those people who are attending these sessions, they have already we have already sent them the link for the recording. But for public, these are also available on the YouTube. Yesterday, we covered roughly 11. We were talking on point number 11, and we covered up till point number 10. Okay, so we were discussing impairment of goodwill. And impairment of goodwill is basically what we learned yesterday. We learned that, like, if a company is using partial goodwill method, then only part of the impairment will be reversed. Then we discussed if an organization, if an entity applying full goodwill method, then the total of the impairment will be reversed. And thereafter we discussed about a cash generating unit, subsidiary being a cash generating unit. If there is any impairment, so what is the method for the calculation of that goodwill, impairment loss. And we learned that you will be adding goodwill related to that subsidiary to the carrying amount of that subsidiary. This will give you the carrying amount for comparison to the recoverable amount of that cash generating unit, that subsidiary. And if recoverable amount is lower than the carrying amount, so the difference is basically impairment. And thereafter you will be passing the journal entry to record this impairment. This is with reference to the illustration number 11. Now comes to the illustration number 12. We have here illustration number 12. Illustration number 12. Okay, this is the 12. This is illustration number 12. At the year end, an impairment review is conducted on an 80% owned subsidiary. At the date of the impairment review, the carrying value of the subsidiary's net assets were $400 and the goodwill $300, of which 20% $60 is attributable to the non-controlling interest, and the recoverable amount of the subsidiary is $500. Company uses full goodwill method. Calculate the impairment of the goodwill. So first of all, as we did yesterday, we shall be calculating the impairment loss. We shall calculate the impairment loss like impairment loss, subsidiaries net assets net assets given in the question, that is 400, and the goodwill. Goodwill 300. This will give us 700. This is the carrying value of the subsidiary. Now, recoverable amount is given in the question. Recoverable amount is given in the question, and that is 500. Here you can see that recoverable amount is less than the carrying amount. The difference will become impairment loss. Impairment loss, and that impairment loss is 200. So this is our requirement number 1. See, calculate the amount of goodwill to be shown in the group financial statements. See, for B part, because this is a full goodwill method, so this means our recognized goodwill is equal to $300 and less impairment loss, which is 200, because this is a full goodwill method. The whole impairment loss will be deducted from the recognized goodwill. So this will give us the amount of goodwill, in the statement of financial position. So this is B. Then is C. Very simple, and that is, of course, credit goodwill account with 200 and debit consolidated retained earning and debit NCI. The calculation will be like 200 into 80% and 200 into 20%. So this will give us 160 and 40. So this is our discussion about impairment of the goodwill. Whenever you feel like any journal entry or any calculation is not clear, feel free, you can ask the question there and then, so that before moving to the next illustration, I could answer that question. Okay. So this was impairment. Then is negative goodwill, bargain purchase.
Burhanuddin asking a question, sir.
Yes, please.
If a parent company acquires a small and medium-sized entity that do not adopt IFRS standards, how it affects the consolidation process?
See, we studied yesterday IFRS 10, which clearly says, especially in your situation, if subsidiary is not applying IFRS, but while preparing the consolidated financial statements, another set of financial statement will have to be prepared for that subsidiary, which will be in accordance with International Financial Reporting Standard. I give you the example of General Electric. I was the component auditor of General Electric here in the Republic of Yemen. Here they were preparing, we were preparing those financial statement. In fact, management was preparing and financial statement of the branch of the like General Electric here in the Yemen using IFRS. But for consolidation purpose, another financial statement was being prepared in accordance with the US GAAP. So this was an example related to the US GAAP. So far as the IFRS is concerned, as we discussed yesterday, you will have to prepare another set of financial statement in accordance with IFRS for the purpose of consolidation, because subsidiary will have to you will have to apply the accounting policies of the parent while consolidating the figures of the subsidiary. Burhanuddin, I hope it is clear. Okay, so negative goodwill, bargain purchase.
Saying thanks.
You're welcome. See, a bargain purchase. A bargain purchase arises when the amount of net assets acquired exceeds the consideration transferred. Negative goodwill is immediately credited to the profit and loss. If profit and loss is not given in the question, then credited to the group retained earning account. See, when negative goodwill arises, so the whole amount will be credited to the group retained earning or profit and loss account, one and the same thing. Okay, if we just go to illustration number 12, illustration number 13. So this is a small illustration which will explain this concept. P company acquired 100% of ordinary shares of company S. The negative goodwill arises amounted to 500. So what will be the journal entry? Very simple. The journal entry will be debit cost of investment 500, credit consolidated or group retained earning account 500. So this is the simple entry because you recorded fully in the year of acquisition. So subsequently, you do not need to worry about it. Okay. Now let's move to the next concept. Next concept is contingent consideration. See, contingent consideration is basically International Financial Reporting Standard 3 requires recognition of contingent consideration measured at fair value at the acquisition date. It is usually an obligation of the acquirer of the subsidiary to transfer additional assets or equity interest to the former owner of a subsidiary as a part of the exchange for control of subsidiary if specified future conditions are met. The requirement for recognition of contingent consideration have been amended. IFRS 3 requires contingent consideration has to be recognized at the fair value even if payment is not deemed to be probable at the date of acquisition. So we have a small illustration to discuss or to explain this concept. Illustration number 14. As per illustration number 14, so we can make some space here. And we can bring down this illustration as well. So our solution and the illustration should be on the same page. But I know that we already sent these handouts yesterday, so these should be in front of you. Delta acquires 100% of the equity of Beta on 31st December 2008. There are three elements to the purchase consideration. An immediate payment of 5 million and two further payments of 1 million if the return on capital employed exceeds 10% in each of the subsequent financial year ending 31st December. All indicators have suggested that this target will be met. Delta's cost of capital is 7%. Required. Determine the value of investment and double entry for contingent consideration. See, we can note from the question, there is an immediate payment and then there are two payments, each of 1 million. But one payment will be made on 31st December 2009, whereas another 1 million will be paid on 31st December 2010. And cost of capital is 7%. So we need to calculate the value of the investment or the consideration. Here we can see that immediate cash payment. Immediate cash payment is 5 million. Immediate cash payment is 5 million. And then there are two payments. One is payment on 31st December 2009. Payment was 1 million into 1 year discount factor 1.07. So this will give us 0.935 million. 0.935 million. And similarly, another payment which will be made on 31st December 2010. This will be 1 million into 1 divided by 1.07 raised to power 2, because this is being made after 2 years from the date of acquisition, 0.873. So the total will become total consideration, which will be debited to the cost of investment account, is in fact 6.808 million. So this is the total consideration. And double entry will be to record this transaction. Double entry will be debit cost of investment account, cost of investment account, cost of investment account, 6.808 credit, as we immediately paid cash of 5 million, and the remaining amount as a liability, deferred contingent liability. Contingent liability. Simply this is a liability account, in fact. And that is 1.808. A part of this liability will be short term. A part of this liability will be short term and part will be long term. Because one payment, 1 million will be paid after 1 year, whereas another 1 million will be paid after 2 years. So this is very simple, because contingent consideration, there is a time involved, so you will be incorporating the concept of the time value of money and recognizing it. And similarly, this liability will unwind When you will unwind it, of course, your liability will increase and this will become your finance cost. Okay, so this is the contingent consideration. Next is deferred consideration. Deferred consideration is, as we know, an agreement may be made that part of the consideration for the combination will be paid at a future date. This consideration will therefore be discounted to its present value using the acquiring entity's cost of capital. Okay. So again, time value of money concept. Very quickly, we can discuss it with reference to this small illustration. The parent acquires 75% of the subsidiary's $90 million $1 shares on 1st January 20x8. The parent paid $2.5 per share and agreed to pay a further 115 on 1st January 20x9. The parent company's cost of capital is 10%. Calculate the total consideration for the purpose of calculation of goodwill. Very simple. We know immediate payment is like in the form of shares. Just 1 minute. Let me make small space over here. Okay, here it's good enough. See, consideration in the form of shares was 90 million shares into $2.5 into 75%. This will give us 168.75. Okay, then deferred consideration, the amount which will be paid subsequently. Deferred consideration, and that is 115 million. This will be paid on 1st January 20x9. So this means after 1 year, so we shall apply 1 year discount factor to this amount, 1.10. 1.10. So this will give us 104.55, and the total is 273.3 million. This is the total consideration which will be used for the calculation of goodwill. If you people have any question while I am making this calculation, please feel free, ask there and then. Because once we move,
will the cost of capital charges to equity account in subsequent years?
Will the
cost of capital charges to equity account in subsequent years?
Who is this gentleman?
Atif Bhatt.
Atif Bhatt, see, I suppose you are talking about the unwinding of that liability. So unwinding of that liability will be a finance cost for the parent, and that will be debited to the whole amount will be debited to the consolidated retained earning, or to the, if you are preparing profit and loss, then the whole amount will be debited to the profit and loss of the parent. It has nothing to do with equity. Atif, but I hope it is clear now.
Yes. He's saying yes. Okay. Thank you.
You're welcome.
No, that was there.
Okay. Okay. Now the next small concept is expenses and issue cost. Expenses of combination such as lawyers and accountants fees are written off as incurred. However, IFRS 3 requires that the cost of issuing equity are treated as a deduction from the proceeds of the equity issue. Share issue cost will therefore be debited to the share premium account. Issue cost of financial instruments are deducted from the proceeds of the financial instrument. So this is the treatment of expenses of the combination, which you normally pay to the lawyers and accountants. But in addition to that, if you have achieved that combination through share exchange, and there may be issue cost to that exchange. So there, that amount will be debited to the share premium account. And similarly, if you have and the issue cost related to the financial instrument, that will be deducted in accordance with IFRS 9. Okay. So this is all about expenses and issue cost. Now, some other concepts. I'm going to pop up a couple of small questions so that in order to wake you up and to make you more participatory. So please be attentive. We are going to ask a couple of pop-up questions in a while. See, next is intra-group trading. We all know that there is a concept of like markup and margin. So I just, those will be very simple, but I want you to answer them very carefully. Can we write a small pop-up question?
In a way.
Yes. Sales is equal to
Please provide me a statement of
yes.
person.
Sales is equal to 60,000. Sale is equal to 60,000. No, this is not an option. This is the main statement. 60,000 and markup on cost is equal to 16.67%. No, just 1 minute. Just fine. Sorry, 20%. 20% required.
Okay.
Calculate the gross profit. Options are
calculate the gross profit.
Yes. Options are 12,000 and 10,000.
Calculate the gross profit where sales is equal to 60,000 markup on cost is equal to 20%. Okay. So I'm going to pop it up here. Okay. So here we go. I have launched the code question.
Write another question. Should I do it?
Okay. Please go ahead with the statement. Participation is very low.
Actually, we are discussing very basic concepts, so maybe some of our members feel like this very simple, but in fact, this could be very helpful for many people because we were receiving requests for this from last 2 years.
Mariam is asking whether the sales are 6,000 or 60,000.
60,000.
60,000, Mariam.
No, you have not written on the.
Sorry. I have written, but I think I have missed a figure, zero figure.
No, correct it. Otherwise, this will create altogether a different.
Okay. I'm going to close this one and then edit. So this question will going to be appear in another poll because one of our member have identified a small mistake, but typing error, I must say.
This is another poll question.
So I am going to pop up the revised question that appeared a little bit before. So guys, here the rectified one. The code is updated. What do you want me to calculate? Calculate?
No. The first two information is the main narration for your pop-up and
Gross profit, calculate the gross profit?
yes.
Okay. Gross. So what, guys, I'm going to close this poll. The statistics from the first poll is that 34% people saying 12,000.
Okay.
While 66% people are saying 10,000.
Okay, 66% people are correct. And for those colleagues who are in fact thinking perhaps 12,000 is correct.
I have launched the other poll as well.
No, it is better we should have explained it earlier. Also, please don't respond to the next poll. We shall be launching that after a few minutes. Before that, because 34% people are saying 12,000, so that needs some explanation here. The explanation for that is, in fact, see, what was my question? Can you? It was
calculate the gross profit.
Okay.
Where sales is equal to 60,000 and markup.
We need to calculate the gross profit. Okay, fine. And other information?
We have two options.
No, I am not interested in option. What was the actual?
Sales is equal to 60,000.
Okay.
And Markup on cost is equal to 20%.
Markup on cost is equal to markup on cost is equal to 20%. People who answered 12,000, they simply applied this 20,000 to this 60,000. Please, this is markup on cost, and this is sale. So please, just sales, we know that sales minus cost of sale is equal to gross profit. And here we know that sale is given. We don't know cost of sale, but we know one thing for sure. Gross profit is in fact 20% of cost of sale. So with the help of this small equation, we can solve it. But it is better you should avoid this small mistakes, but I'm happy majority of the people are correct. 0.2, we can write it as 0.2 cost of sale. When we transfer this minus cost of sale, this will become positive, and this will become 1.2 cost of sale, and here it will become 60,000. And thereafter, we can calculate, oh, where are we? Yes, here we can calculate. Because this small concept is important for the area which we are covering. Here, this means cost of sale is equal to 60,000 divided by 1.2. This will give us 60,000 divided by 1.2. This will give us 50,000. So this means gross profit is equal to sales minus cost of sales as we have calculated. So this will give us 10,000 profit. So 10,000 is correct. Or for short, please, those 34%, please memorize this small formula in case of markup. Like cost of sale is equal to sales divided by 1 plus markup. So here we have 60,000. So you can simply, I made all that explanation just to share with you the logic. Just to share with you the logic. Otherwise, you can simply remember this formula from this. If markup is given and sale is given, so you can apply this formula to calculate the cost of sale. Then the difference of the sale and the cost of sale will become the gross profit. And but if markup is given and cost of sale is given, that is very straightforward. Simply multiply that markup on cost with the cost. This will give you the gross profit. Okay, now please pop up. Do we have any question, or otherwise pop up another question?
We have I think there is a question over here.
Yes, please.
What about the goodwill including in contingent consideration? You said that it would be recognized immediately, but the illustration to that does not show that part. That is treatment of goodwill in contingent consideration. You only covered the treatment of contingent consideration.
Yes, you are right. You are right.
And not the goodwill including in
who is
it.
this gentleman?
Muhammad Aziz.
Muhammad Aziz, see, here you are very right. Illustration only covers the consideration part, because contingent consideration will only affect the consideration part. So far as the credit side is concerned of the cost of investment account, that will not be affected by the presence of the contingent consideration. The purpose of the small illustration is just to focus on the point which is being discussed. Arshad, I hope it is clear. Okay.
Okay, we have popped up the other poll. Yes, he's saying yes. It is clear. I have popped up the second poll. So all the attendees are requested to participate in this poll. I think I must close it now because it's already 1.5 minutes.
Yes.
So guys, I am going to close this whole question in a bit right away now. 48% people saying 7,200, while 52% are saying 8,000.
52%. 48% saying
7,200.
7,200 and
52% people saying 8,000.
See, 52% people are correct. Again, this is very important thing. Like this huge percentage, this is a very basic concept. Normally we think perhaps we are very well conversant with these small concepts, and of course these are the contributory factor in the ultimate big problems. So it is better we should revise it now. Okay, so let me explain it on this Word document. See, what was, can you please repeat our question? Khyam, can you please help me in this regard? Yes, please.
Okay. Calculate the gross profit.
Okay.
Where the cost of sales are 72,000.
Cost of sales 72,000.
And margin on sales is equal to 10%.
Okay. So requirement is, in fact, calculate gross profit. Cost of sale is equal to 72,000, isn't it?
Yes.
Okay. And margin
10%.
Margin on sales. I should not have mentioned on sale. Margin is normally on sales, but anyway, I just to not to make it much difficult. See, we shall use the same equation like sales minus cost of sales is equal to gross profit. We don't know what is the sale, but we know cost of sale is 72,000 and gross profit is 10% of sales. So we can write it like this: 0.1 of sales, and here sales minus 72,000. This is minus. When this will be transferred on the right side, this will become positive, and this is positive. Without any sign, this is positive. So when we will transfer this figure to the left side, this will become negative. So sales is already on the left side, minus. When we will transfer 0.1 sales, this will become minus because it is transferred to the left side, and because we are transferring 72,000 to the right side, this will become positive. So sale will become common, and 1 minus 0.1. 72,000. 72,000.
So sales will be equal to.
So Khayyam is very helpful. Thank you very much, Khayyam, for your help. Sales is equal to 72,000 divided by 0.9. So this will give us how much?
80,000.
80,000. This is your sales. So sales minus cost of sales is equal to how much?
8,000.
8,000. So 8,000 is the correct answer. So again, we can memorize a small formula for future. This will help you, like cost of sale divided by 1 minus margin. 1 minus margin. This is the small formula which you can memorize when you want to calculate gross profit, and cost is given and margin on sale is given. So on top we have another formula like this. Almost we can see that only we have swapped cost of sale and sale. When you have markup, use this formula. When you have margin, use this formula. But there are other ways as well. But I appreciate 52% that they answered correctly. Okay, now if we don't have any question related to this explanation, so we can move to next area. Next area is.
No questions are there, sir.
Yes, please. Yes.
No questions are.
Okay. Intra-group trading. In intra-group trading, unrealized profit arises when the related goods or inventories have not subsequently been sold to customer outside the group. So the objective of last two pop-ups and the subsequent explanation is to help us in the revision of this concept. If goods are sold by the parent to the subsidiary, see who sold the good? Parent sold the good. So in this case, parent made the profit. So if any of those goods are still lying unsold in the inventory of the subsidiary, then we will have to account for that unrealized profit. We'll have to account for unrealized profit on that inventory, which is still lying unsold in the inventory of the subsidiary. And if goods are sold by the parent, by the subsidiary, then unrealized profit would be debited to the group retained earnings and non-controlling interest according to their proportionate shares. Very simple. The concept is very simple, we know. See, in this case, I suppose I should have pen here. Yes, I have a pen here. Yes. In this case, sold by parent. So who earned the profit? Only parent earned the profit. So here debit will be consolidated retained earnings, the whole amount, and credit, of course, consolidated stock. Stock will be reduced with the same amount. And here profit is made by the subsidiary. But one thing is same in both cases. Consolidated stock will be reduced by the amount of unrealized profit. By the amount of unrealized profit. Now, so far as the debit is concerned, in this case, of course, consolidated retained earning will be debited. But profit of subsidiary is in fact related to two parties, one parent and other non-controlling interest. So these accounts will be debited in their respective proportion, like percentage of parent will be applied while calculating the amount for consolidated retained earning here, and minority interest will be applied to the unrealized profit figure to calculate the amount to be debited to the non-controlling interest. Okay. Okay, let's have a look at small illustration. Illustration number 16. This is the illustration number 16. P company sold goods to S company. P is parent, in fact, amounting $1,250 at a markup of 30%. Half of the goods are still in stock. S company is 80% owned subsidiary of P company. Okay. First of all, we shall be calculating the unrealized profit on stock. Can you please quickly calculate? Just use the formula. Just use the formula we have just seen, and I'm sure you must have noted that. Just give me the calculation in your comments. What is the unrealized profit? See, this is in fact
144.
Sanaullah, you are correct. This is 144. Goods sold to S is 1250. This is the, in fact, the amount at which these were sold, 1250. 50% of them are still lying in our stock, means 625. This is the sale amount. We know from our earlier discussion that if you are given markup, our formula will be cost of sale is equal to sale divided by 1 plus markup. So here we will be applying 625 divided by 1 plus markup, 0.30. So this will give us 144. Can you check it? I suppose I can do it. Okay, no problem. Our figure is correct. 625 divided by
1.3 is equal to 481.
No. Just one minute. Markup 625 amounting to, see, there is small correction in the question. This is in fact okay, fine. 625 divided by 1.3, this will give us the cost of sale minus 625. Okay. So
this is about
what is the value?
144.
No. Cost of sale, because this formula will give us the cost of sale.
This is 480. 481.
No, fine. So I was supposing it should be 144. Why it is coming 480? In fact, this is cost of sale. So our gross profit will be sale minus cost of sale. So this will give us 625 minus 480. This will give us 144. This is the unrealized profit on stock. Unrealized profit on stock. Okay, the entry is simple. Who made the profit? Parent made the profit. Parent made the profit. And one thing we know for sure, like credit will be stock. Consolidated stock will be credited with this unrealized, with this amount, 144, the amount of unrealized profit. And because parent made this profit, so we will debit consolidated retained earning with the full amount, 144. So this entry, once passed, will reverse the unrealized profit on stock.
Mansoor is asking, won't it be like sales divided by 1 minus markup?
No. So we have
why we ruled out non-controlling interest share of profit in group trading, where subsidiary sold goods to parent.
Who said?
I believe parent has no control on NCI of the subsidiary. I am a bit confused. Assistant.
Ashad, just tell me in yes or no. Your question is related to when goods are sold by the subsidiary. Is this your question, Ashad?
Yes.
So just wait for a while. Once we discuss illustration number 17, I will try to answer your question. Okay, now come to the illustration number.
Another person is asking the question.
Yes, please.
Krishna asking, what will be the entry for unrealized profit of current year if there is opening unrealized profit as well from last year?
Krishna is asking what?
What will be the entry for unrealized profit of current year if there is opening unrealized profit as well from last year?
No. If there is an opening unrealized profit, so that inventory is normally supposed to be sold during the year.
Yes.
So this entry will remain there. This entry will remain there. Okay. Now let's go to illustration number 17. In illustration number 17, the goods are sold by the subsidiary. For the same amount, we can see that, and we have already calculated the unrealized profit on stock for these figures. So we need not to worry about that we will have to recalculate unrealized profit. So unrealized profit, as we have seen in the last illustration, because same information is being used for this situation. So this is the unrealized profit. So we know stock will be credited. Stock will be credited with unrealized profit on stock. See, this is the profit. Okay, and debit will be consolidated retained earning with 144 into 80%. 144 into 80%. So this will give us, I suppose, 115, and debit NCI account, whereby the calculation will be 144 into 20%. So this will give us
28.8.
29. So this will be the entry. Earlier, Asjad asked the question.
Yes.
Asjad, see, I suppose your question was why we are debiting NCI, why the whole amount is not being debited to the CRE. See, this in case of illustration number 17, this 144 profit was earned by the subsidiary. this is the profit of the subsidiary, and anything in the subsidiary, any profit in the subsidiary will be divided into two parties. Majority share will go to the parent and minority share will go to the non-controlling interest. So when we will reverse the profit which is related to the subsidiary, the same principle will apply. Whereas in case of illustration number 16, the whole profit was earned by the parent because goods were sold by the parent. So that's why consolidated retained earning was being debited along. Ajit, I hope it should be clear. If you have any other specific comment or questions, so please feel free to ask.
Burhanuddin asking a question. The rule that group stock should be reduced by unrealized profit of stock held in consolidation.
Just again, please.
The rule that group stock should be reduced by unrealized profit of stock held in consolidation. Should this rule apply on preparation of individual financial statements of both entities accordingly?
No. This will not apply. This will not apply because in their separate financial statement, they are separate legal entity. They are separate entities. And in the group accounts, they are considered as one. So you cannot make profit from your own by shifting inventory from one warehouse to another warehouse and recording the profitability. So in group, it is considered that all companies are one. So that's why you cannot have unrealized profitability element in your stock as per International Accounting Standard 2, which says your stock should be held at the lower of cost and NRV. So this principle will apply on the group accounts. Whereas if parents sold the stock to subsidiary, so subsidiary in subsidiary separate financial statements, so this stock does not belong to the subsidiary because subsidiary has purchased it from the parent. So profit element can be there in their individual financial statement. Similarly, if subsidiary has sold goods to the parent, so in the separate financial statement of the parent, the stock which was bought from the subsidiary can have a profit element on that earned by the subsidiary. I hope it should be clear.
Mohammed is asking, no, my question was on the other way around. Because why we do not credit the stock with 115 and debit only the group retained earning with the same amount?
Okay. See, I said why we do not only use this and then instead of 144 we use 115 like this, as it, isn't it?
Yes.
Okay. See, I said what happened. In fact, if we just discuss the logic, when subsidiaries sold the stock, I'm discussing logic, be careful. So that subsidiary made a profit of 144 on that stock. That profit was divided between NCI and CRE by crediting both accounts. Now when we will reverse it, so of course these two accounts will be reversed. If you just reverse 115, this means 29 will remain unreversed both in stock and in the NCI. I said I hope it should be clear. Because earlier, what happened? Like your subsidiary made a profit, you can simply divide it. You can simply divide. There are different approaches, like your subsidiary made a profit before, passing any entry, you reduce like unrealized profit. That is another situation. But in reality, like the profit of the subsidiary includes 144. So by passing this entry, in fact, you are reversing that profit which is already recognized in the CRE and CN. But if you just pass for 115, 29 will remain there in the NCI and the stock, which is especially in the stock, which is against the International Accounting Standard 2. So that's why this principle is based on the IS 2. As I hope it should be clear, because this is the basic logic, in fact.
Okay, does unrealized profit only arise if there is closing inventory left in subsidiary entity?
Yes, only if there is
As it's saying, I got the point.
Okay. Now we move next. This was illustration number 17. Now, okay. Now is intra-group sale of non-current assets. See, in this case, the same approach will be applied as we used in case of unrealized profit on inventory. Because when there is a sale of fixed asset between the group companies, so there could be unrealized profit, or there one group company might have earned profit on this transfer. But there is another problem which arises, which makes it a little different, or its treatment is a little complex. That is depreciation. Like you have an asset, parent has an asset, parent of $100. Parent transferred that asset to the, or sold that asset to the subsidiary for $120. Now subsequently, subsidiary will start depreciating that asset based on $120. Whereas this was its carrying amount in parent account was $100. So there are two elements now. One, the profitability of $20 earned by the parent, and additional depreciation which is being charged on that asset. Because when you prepare the consolidated accounts, so this asset will again become, all companies will become one, and this asset will become the part of that company. So again, there will be an element of unrealized profit and additional depreciation charged by the subsidiary. Now there are two approaches. Now I will be explaining both approaches with the help of illustration, and you will have to see which approach is being applied in your jurisdiction. Because if you go into the accounting literature, you will find both approaches, but which one is more preferable by your regulators, and similarly I'll be commenting on which one is more prevalent. But we need to learn both approaches as well, because being a vibrant community, you people can move from one country to other country, because your education allows you, your education enables you to serve in different jurisdictions, because the basics, your basic education empowers you to serve in different jurisdictions. So in case you move from one jurisdiction to another jurisdiction where second approach is being followed, so you should be comfortable with that as well, or otherwise you can relook to the material which we are going to discuss now. Okay, intra-group sale of non-current asset. See, when companies make intra-group sale of non-current assets, two approaches are there to deal with unrealized profit and reversal of additional depreciation. First of all, sale by parent to subsidiary. Who earned the profit? Parent. And who is charging the additional depreciation? Subsidiary. So what is the approach one? When parent sells non-current asset to subsidiaries, two approaches are there to deal with the unrealized profit and reversal of addition. So this is the approach number one. So what is this approach? For unrealized profit, sorry, because this is earned by the parent. This is earned by the parent. So we shall we shall debit the consolidated retained earning. You can see that over here. And what is this? This is in fact unrealized profit. Unrealized profit. And similarly, because additional depreciation is basically in the accounts of subsidiary. So first you will calculate the amount of the additional depreciation. This is basically the amount of the additional depreciation. What is the depreciation on increased amount, and what could have been depreciation on the original amount? So the difference between these two figures is the additional depreciation. But see, because now accounts of subsidiary are involved, so anything which is related to the subsidiary belongs to two parties, parent and minority, non-minority people. So that's why that effect will be accordingly reversed in the CRE and in the non-controlling interest in their respective percentages. In order to understand it, we can use an illustration. We can use an illustration, and that illustration is basically, yes, illustration number 16. We can use illustration number 16. We have here illustration number 16. No, I suppose I wrongly mentioned illustration number 16. In fact, illustration number 18. Yes, the next illustration is illustration number 18. This is the illustration number 18. Okay, this is the illustration number 18. AL acquired 80% investment in DL. Both the companies depreciate equipment at 10% on straight line basis. On 2nd July 2013, AL sold certain equipment to DL as detailed below. Cost of that equipment was 40 million. Accumulated depreciation was 30 million. Sale proceeds 25 million. Pass the double entry for unrealized profit and additional depreciation. See, here we shall be using approach 1. Here we shall be using approach 1. Okay, here we shall be using approach 1. First of all, we can calculate the profitability element. So this is the cost and this is the accumulated depreciation at the date of sale. So this will give us the net book value or the carrying value of this asset. Very simple, we know, all of you know, this is 10 million. And this is sold for 25 million. So this means unrealized profit or unrealized profit on this transaction is unrealized profit on this transaction is very simple, 15 million. As we decided, if we apply approach 1, who earned the profit? Parent earned the profit. But one thing for sure, whether the profit is earned by the subsidiary or the parent, you will always credit consolidated non-current asset. You will always credit consolidated non-current asset account with the full amount of unrealized profit, in this case, which is 15 million. Now, next is we have to see who earned the profit. Here, parent earned the profit. So this means the whole amount will be debited to the consolidated or group retained earning. One and the same thing, interchangeably use these words, 15 million. So this is under approach 1. This is one entry for the reversal of unrealized profit. And additional depreciation will be in the accounts of subsidiary, because after this disposal, now this asset is being depreciated in the accounts of the subsidiary. So first of all, we shall calculate the additional depreciation. What is the additional depreciation? See, the additional depreciation, because it is being charged 10% on a straight line basis, and it is sold on, okay, it is sold on 2nd July 2013, and we assume that here, please you can include over here, because a part of information is missing, because this is taken from a exam level question. So we are making these entries on 30th. So I should mention in the requirement. So it is better you should. Okay, let me see if I can use this. Okay, I can go back. No, still my. Okay, so we are assuming that we are making this. Okay, I should write here, because when you look at the recording, assumption is like we are doing this calculation on 30th June 2014, after 1 year. See, as it is mentioned, 10% straight line basis. So what is the depreciation? The depreciation is 1 point. Okay, we do not need this assumption, because this is the additional amount for which this was sold, and it is being depreciated on 10%. So this will give us the additional depreciation. Otherwise, we will have to make few more assumptions. So keep the concept very simple. Like if the asset is sold at a higher amount, the excess amount, because that will cause the additional depreciation. So 15 million excessive amount will result in 10% additional depreciation each year. So the 10% is 1.5 million. Now the entry will be if I write here smallly, like depreciation, accumulated depreciation. You can debit non-current asset as well, no problem. Consolidated one, this will have one and the same effect, but accumulated depreciation will become 1.5 million. Credit consolidated retained earnings, group share of 1.5, which is 1.2 million, and then credit non-controlling interest with 0.3 million. So this is approach 1. We can have a short break. Thereafter, we will continue from the same point. Okay, welcome back. We discussed illustration number 18. Okay, now we move to illustration number 19. See, on 1st October 2010, it should be in front of me as well. On 1st October 2010, Prodigal purchased 75% of the equity shares in Sentinel. Immediately after the acquisition of Sentinel, on 1st October 2010, Prodigal transferred an item of plant with a carrying amount of 4 million to Sentinel at an agreed value of 5 million. Sorry. At this date, the plant had a remaining life of 2.5 years. Prodigal had included the profit on this transfer as a reduction in its depreciation. We are ignoring this because this relates to, we can say that, I mean, this is nothing to do with our current concept. Okay, all depreciation is charged to the cost of sale. Pass double entry for unrealized profit as at 31st March under approach 2. Okay, so first of all, we have look at, this was approach number 1. Now, first of all, before solving the illustration number 19, we can have a look at approach number 2. Very simple approach. Here, simply net off two things. Simply net off. Unrealized profit and additional depreciation. Unrealized profit and additional depreciation. Additional depreciation. So this will give you a net amount. So with that net amount, simply non-current asset credit and consolidated retained earning debit. Instead of 2 entries, under approach 2, you make only 1 entry. With reference to the company who made the profit. Here, parent made the profit. So you made the entry of this net amount with reference to the parent. And that's it. See, if we just ponder on these two approaches, we will find that approach 1 is more logical. Approach 1 is exactly reversing those figures which should have been reversed. Whereas approach 2, so far as the unrealized profit is concerned, is correctly reversing it. But so far as the additional depreciation is concerned, we are ignoring non-controlling interest part of the additional depreciation. So that's why approach 1 is more logical, and it should be preferred practically instead of approach 2. But being an accountant, we must we must be able to appreciate approach number 2 as well. Okay, let's understand with the help of the illustration number 19. In illustration number 19, we can see that What is the unrealized profit? Very simple. The unrealized profit is unrealized profit on this fixed asset is.
Sir, can we repeat the approach again, as we'll have some attendees who cannot be able to receive the presentation?
Why?
I don't know, but I have just reconnected the presentation, disconnected and then reconnected. The issue has sorted out.
Now it is sorted out.
Yes.
Okay, this means I was not knowing, but something has happened, isn't it?
The presentation on our side was displaying, but lots of people are saying, like 5 to 6 people are saying that they are unable to see the slides because they have been struck.
Okay, I can go back to that slide, but you people already have these slides on GoToWebinar and Google Doc link. So it is better you people must download that before attending this session or during this session, so that this sort of problem should not hurt your understanding, should not affect your understanding, and should not affect the flow of the discussion. See, as I mentioned, this is approach 2. Here in this approach, simply calculate unrealized profit and whatever is the amount of additional depreciation, calculate the net amount and simply pass this entry. Instead of passing 2 entries, just simply pass this entry. So if we just analyze it with approach 1, approach 1 is more logical, because by passing 2 different entries, one for unrealized profit and one for additional depreciation, the effect of depreciation, we are in fact reversing the exact effect of that transaction under approach 1. So approach 1 is more logical, but approach 2 is also being used, though it is not very logical. But anyway, we must be knowing both the approaches. But if you have an option, if you have an option to apply, I recommend that you should go for the approach 1, because this is preferable in practice and this is more logical. Okay, let's, I hope our respected members who are disconnected now, you people are fine. Can you please respond?
People are seeing the slides now, okay, because nobody has pointed out later on. Fine. Does approach 1 depict more true picture of accounts, Mohammed Zuhair Chaudhary?
Mohammed Zuhair Chaudhary, you are right. It's like this. Okay, unrealized profit. Okay, I can use here. This one. Okay, unrealized profit. Unrealized profit is equal to this 5 minus 4, 1 million. This is the unrealized profit. And the remaining life is 2.5 years. And when this transaction took place on 1st October 2010, and now is, or the date when we are preparing these accounts is 31st March 2011. So additional depreciation for 6 months. So first of all, we will calculate additional depreciation. Additional depreciation can be calculated for 1 million, because this is the additional amount which was charged, and depreciation will be related to this part. 2.5 years. 2.5 years into 0.5 year. This will give us depreciation for additional depreciation for a year, and by multiplying it with 0.5, this will give us additional depreciation for 6 years. So 0.2 is the additional depreciation. Khayyam, I suppose you can check it as well. Fine. So the entry will be under approach 1. So entry will be, okay, debit. I think I should change colors so that one could differentiate easily. Debit, because profit was earned by parent, consolidated retained earnings with 0.8 million, and similarly credit non-current asset with 0.8 million. So how we calculated 0.8 million? 0.8 million is basically is equal to 1 minus 0.2. So this gave us 0.8 million. And this 1 is in fact unrealized profit, and 0.2 is basically additional depreciation. So this is the additional depreciation, and this is the unrealized profit. So this is the approach 2. Okay, now we go back. And next is if fixed asset is sold by the subsidiary to parent. Under approach 1, when you will calculate unrealized profit on stock, of course, non-current asset, consolidated non-current asset will be credited with unrealized profit. But because this profit was earned by subsidiary, so the profit of subsidiary is in fact related to two parties, parent and minority interest. So that's why you divided this unrealized profit among these two accounts in their respective percentages, in their respective proportions. Similarly, any additional depreciation will be reversed in parent accounts only, because asset was sold by subsidiary to parent, and after sale, parent is basically charging any depreciation on that increased amount. So this is approach 1. And similarly, in this case, approach 2 will be the same one. Like what you will do, you will deduct the additional depreciation from the unrealized profit to reach this figure, AAA. And that AAA will be credited to the non-current asset, and the effect will go to these two accounts, because in approach 2 we make this entry with reference to that entity who sold the non-current asset. So this is approach 2. Let's have technical problem, and no, I mean that is resolved. Sale by subsidiary to parent. This is approach 2, and the approach 2 is similar as we discussed for the parent. The same entry, except the difference is like because parent sold the asset. So in approach 2, this entry will be with reference to the entity who sold the non-current asset. Okay. So let's discuss sale by subsidiary under both approaches with the help of this small illustration. See, FL purchased a machine for 20 million and sold it to HL. Okay, however, no payment has yet been made. The estimated useful life HL. Okay, I wanted to actually see which one is the parent. HL is the parent. HL is parent. HL is parent, and FL is basically subsidiary. Okay, subsidiary FL in fact sold an asset to HL. So first of all, we will calculate unrealized profit, which is quite straightforward. What is the unrealized profit? That is quite straightforward. That is unrealized profit is equal to 4, I suppose million. Yes, 4 million. And the estimated remaining useful life of the machine is 4 years, and HL charges depreciation on the straight line basis. And this is happening on 1st January. This is happening on 1st January. And we are preparing account on 30th June. This means additional depreciation for 6 months. Additional depreciation for 6 months. So additional depreciation. So it is better before passing the entries we are calculating additional depreciation. Additional depreciation can be calculated like 4 million is the additional amount, and it has got 4 years life, remaining life, multiply with 6 months, 0.5, half year. So this will give us 0.5 million additional depreciation. So here we can use approach 1, approach 1 and approach 2. Approach 1, approach 2. Under approach 1, see, first of all, we shall make an entry. As we know, under approach 1, we make a different entry, a separate entry for unrealized profit, unrealized profit on stock, and that will be because subsidiary earned the profit, But one thing is for sure, that credit will be building account, non-current asset. Non-current asset account, and that is building account which is with 4 million. Now this 4 million is earned by the subsidiary, and we know that if profit is earned by the subsidiary, so reversing, of course, consolidated retained earning will be reversed with their respective percentage. Here it is 80%. So 3.2 million will be reversed from consolidated retained earning, and from NCI 0.8 million will be reversed. Okay, this is unrealized profit under approach 1, and additional depreciation under approach 1 will be like, because profit is earned by the accumulated depreciation is charged by the parent, so accumulated depreciation account will be debit, and credit consolidated retained earnings 0.5 million. So this is approach 1. If you want to apply approach 2, first of all we will calculate a figure which we say give it a name of AAA. So 4 unrealized profit minus additional depreciation. So this will give us 3.5. And we know approach 2 is with reference to who sold the non-current asset. So here subsidiary sold the non-current asset. So again, building will be credited with 3.5 million, and debit will be CRE, and debit will be NCI with their respective percentages. 2.8, 0.7. So this is approach 2. Okay, because I am saving it as well, so when our ACCA team will be sending these documents, so you will have them along with all this write-up. Okay, next is, we know that at acquisition we do the fair value adjustments. See, IFRS 3 revised requires that the identifiable net assets of the subsidiary should be measured at their fair value at the date of acquisition. However, deferred tax and pension obligations are calculated according to the relevant standard. We know that International Financial Reporting Standard 13 define the fair value set out in a single IFRS framework for measuring fair value. Required disclosure about fair value measurements. So what is fair value? As it is defined in IFRS 13, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant at the measurement date. So this is the fair value, and we are not in fact going to discuss IFRS 13, but I am just giving you the reference of the IFRS 13. Just remember that IFRS 13 applies to a standard for the determination of the fair value, except. So we need to remember the exceptions where it does not apply. Mean there are a number of standards where you are required to determine, or where you need to determine, the fair value of a particular asset. So there you will be applying International Financial Reporting Standard 13, except just only note the exceptions. Number one, share-based payment transactions. How can we calculate the fair value of the share-based transactions? What are the principles? What value at what date will be used for the determination of the fair value of a share-based payment will be addressed under IFRS 2. Similarly, if you are applying IFRS 16 leases, if you need to determine the fair value, again you will be determining that fair value under IFRS 16. Similarly, International Accounting Standard 2 was all about, I should be careful, I should use substantially the material related to the basic concepts of the consolidation. But if your bases are strong, you can multi-story building on that. But if your basics are not good, then your building will not work. That will cause you a problem. So never ignore even a simple concept. Master it, understand it, discuss it, so that while preparing the basis for a bigger picture, your base should be strong. Okay, now move to the next complex area, complex groups. See if we have any question, then we can answer, otherwise we can move. So that because
some of the participants have submitted questions before. Let me reiterate. Instead of building it, instead of building it should be machinery. Shazad, this doesn't make any sense. There
no, just
charge
a minute. He's right. Let me see why he's saying so, because let me check the question if it is mentioned. Shazad, you are right. I mistakenly write here. Building anyway, this is non-current assets. You are right. Thank you, Shazad. But anyway, the concept is same. Like, I hope you understand that. This is basically machine or non-current asset, in fact, will be credited, because non-current asset is mentioned or machine is mentioned in the question. Thank you very much.
Okay, there will be no charge to NCI on additional depreciation on approach 1.
Yes, because because additional depreciation is in the accounts of parent. Next.
Net result for approach 1 and approach 2 is not matching.
You are right. So that's why we named them approach 1 and 2. If they are matching, so we could have said, okay, approach 2 is only a compound entry. In fact, it is not. So far as the effect in the machine is concerned, that is the same under approach 1 and approach 2. But so far as the effect in NCA is concerned, that is different.
Okay. What if parent also possess NCA?
Huh?
What if parent also possess NCA? Not complete question.
Parent, no. Parent cannot possess NCA. Whatever share parent possess, that will make him the parent, not the NCI. He cannot say that, okay, I have bought 70% share, okay, I treat 10% as a minority interest and 60% as a majority. No, it cannot.
Okay, what are the exceptions to IFRS 13 fair value adjustment?
Okay, I mentioned 4 things, I suppose. Number 1, share-based payment transaction within the scope of IFRS 2, share-based payment. Number 2, leasing transaction within the scope of IFRS 16 leases. Measurements that have some similarities to fair value but that are not fair value, such as net realizable value in IAS 2 inventories or value in use in IAS 36 impairment of assets. So these are the exceptions.
Okay, we have a question from Zona Rehman. One is share-based payment, other is leases. And what are the others?
Other is like net realizable value in ISA 2 and value in use in ISA 36. So sometimes it seems they are similar to the fair value, but make sure these two standards have their own guidelines for the calculation of the net realizable value and value in use. Next.
Okay, what about losses in intra-group trading?
Yes, these entries will be reversed, and similarly, if instead of additional depreciation, there will be a deficit in the depreciation. But there you need to look into there you need to test that asset for impairment as well in that case.
Please correct me if I am wrong. According to IFRS 3, subsidiaries' net assets will be calculated at fair value. The partial goodwill method will not be used and only full goodwill method will be used as per your presentation yesterday.
No, yesterday we discussed both methods. We discussed partial goodwill method as well as we discussed the full goodwill method. We discussed both methods, and I explained both methods because a company can be applying one method. One company can be applying partial goodwill method. Other company may be applying full goodwill method. So that's why I explained both methods yesterday. Next.
If intra-group transactions occur between two subsidiaries of our same parent, how it affects the consolidated financial statements, Burhanuddin?
Burhanuddin, the same principle will apply. For example, if selected another document. I don't want it to come down. Okay. See, this is a parent. This is a subsidiary 1 and subsidiary 2. If anything happened between these two, the same principle will apply. Because in the consolidated financial statement, all are one company. Any unrealized profit will be reversed. Any unrealized. If S1 earned a profit, that will be reversed. If S2 earned a profit, that will be reversed. But the same situation will apply. Subsidiary earned the profit. Keep it in mind. If subsidiary entered into a transaction with another subsidiary, so this will be treated as if subsidiary initiated the transaction. Burhanuddin, I hope it is clear.
Okay, Zona Rehman saying, Mr. Abu Bakr, can you please repeat approach 1 for double entry of reversed additional depreciation as it was missed due to out of sight slides, and it is
Who is this?
zonal in mind.
Zona, I explained it with the help of like two illustration. So I would recommend you that if you could just see the recording, inshallah, you will be able to appreciate the concept. Otherwise, you can write to me if you have any question, because I need to discuss certain other things, but you will find that in our recording, inshallah, and these write-ups as well. So I hope you will accommodate.
No more questions.
Okay. Okay, now complex groups. See, under complex group, okay, let me open this in front of me as well, complex groups, because complex groups are complex. Vertical group can be like a company is a parent, a company holds 80% of B company, and B company holds 70% in C company. So this is an example of the vertical group. Now the next question is, two things are in fact important here. How you will calculate the effective shareholding? Effective shareholding for the calculation of goodwill and for transferring post-acquisition and pre-acquisition reserves and share capital for the calculation of goodwill and the consolidated retained earnings, and determination of the percentage of the non-controlling interest. So this is important. This is one thing. Second is because we learned yesterday, we will consolidate only from the date of control, when we achieved the control. So the date of control is important, because B might have acquired C at a different date, and A might have acquired B Limited at a different date. So date of control is important. If we are preparing consolidated financial statement with reference to A, so this means A is also controlling C through B. So A will only be able to consolidate C from the date of control, when A achieved the control of the C. So here please note that, first of all, effective shareholding will be like 80% into 70%. So this is your effective shareholding in C. We are discussing everything with reference to A, the ultimate parent. So far as the effective shareholding in B is concerned, that is quite straightforward, that is 80%. But when calculating the effective shareholding in C, so because A is controlling C through B, so this will give you the multiply these two and you will be able to calculate the effective shareholding in C. This means in C, NCI will be 100 minus 56 means 44%. So NCI account will be prepared using 44%, and what you did, don't do it again, because anytime you will do it, this will disappear.
Wait for a moment, because your webcam is going off. I don't know why, but I have to turn it off. So
But presentation was reaching voice
yes.
and everything.
Yes.
Fine. No, can we continue?
Yes.
Okay. But please, because this will disappear. Anytime you will do it in the future, this will disappear.
Okay.
And thanks, I have written few contents otherwise. Okay, 56%. Please make calculation, because I just made the estimate without you. 44%. So this is the NCI. No. What about the date of control? Date of control will be the date parent acquired subsidiaries. See, the date of control will be when, what you want? Any problem?
No problem.
Okay. When, no, there is a problem.
You have to respond to this.
Okay, I responded it. Gone, everything gone.
But I didn't do anything from
No,
there.
I know, but something has happened. Okay, anyway, I can use a Word file and this. I can use this, no problem.
Please remove that.
Okay. Okay. Vertical group. We were discussing vertical group. The time is very critical, so please. Huh? Okay. Let me quickly mention over here. 80%. B. I suppose I mentioned the same thing over there. Anyway, 70%. No, we were discussing the date of control. Date of control. Date of control will be when A, mean parent, acquired, it should be C. It should be C. This is parent. This is subsidiary. And this is subsidiary. This is subsidiary. Okay, when A parent acquired B. If B already holds shares in C, which is the subsidiary. In simple word, what we are discussing, okay, what is the, because so far as the subsidiary B is concerned, there is no confusion. Simply when A acquired B, that is the date of control, and effective shareholding is 80%, and the NCI is 20%. We are discussing these two things with reference to the subsidiary, with reference to the C. If B already holds shares in C, this is the key point of the complex. So far as intercompany trading, intercompany sale and purchase of fixed asset, impairment of goodwill, negative goodwill, positive goodwill, cancellation of intercompany transaction, intercompany payable, receivable, intercompany investments, and the consolidation, all other concepts are the same. Here in complex group, the starting point is you must decide the effective shareholding and NCI and date of control. Okay. Then there are other types of groups. Okay, I can move down. Then that later date, let me mention it here again, then that, later date. Okay. Okay, now we move to another situation, another type of complex group, and that we termed as D group. We termed as D group. For example, D group. For example, a D-shaped group. For example, A holds 70% in B Limited. See, B is subsidiary of A, so there is no problem so far as the effective shareholding is concerned and the date of control is concerned. Effective shareholding is quite straightforward, which is 70%, and the date of control is the date when A Limited acquired B Limited. And C, in C, B acquired 60%. And A has a small direct interest in C as well, that is 10%. So this can be termed as D-shaped group. Now here again, the effective shareholding will be effective. Of course, we are discussing this subsidiary. So effective shareholding will be with reference to A is 10% is direct plus 70% into 60%. So this will give us 60% into 70% plus 20. 52%. 52% is the effective shareholding. So as a result, NCI will be 48%. NCI will be 48% and effective shareholding will be 52%. So these are the complex groups. Here I have given one illustration with the answer, and if you just quickly go through this illustration, because of its length, it is not possible for us to make a calculation here, but just to understand the concept, like especially the important concept is date of control, because effective shareholding, when I calculated for the earlier examples, I suppose this is not very difficult. Date of control is also not difficult, but you need to just be careful in that. See, the draft statement of financial position of IMI, Paul and Alpha as at 31st December 2005 are as follows. IMI, yes. IMI column is this is IMI column. See, non-current assets and current assets, investment in subsidiaries, 180 and 100. Here you can see that IMI invested in Paul and Paul invested in Alpha, I suppose. Okay. Then equity, share capital, retained earnings. Let's see what is the remaining. Okay. IMI acquired 75% shares in Paul on 1st January 2003. What is the, what we can do? We can reduce its size to make it like okay, now I suppose this will be visible as a whole. Okay, fine. Now it's okay. Okay, this is the question in front of us. Requirement, no problem. Requirement, I can tell you. See, IMI acquired 75% ordinary shares in Paul on 1st January 2003 when the retained earning of Paul stood at 50 million. At that date, fair value attributable to the non-controlling interest in Paul was valued at 42 million. Paul acquired, see, this date is important. This date is important. Mm, this date is important. We need ink. Okay, I can take it from here. I can take it from here. Okay. Uh, okay, here you can see that I
Your
want
cam
to.
is already going through this PC.
Hmm?
Your cam is going through this PC.
So can you remove it? Can you?
I have now turned off from my end. You have your rights.
No, no, I have my rights, but I just want to. Okay.
Scroll, squeeze it down
Okay. Yes.
with your mouse. You can squeeze it down with your mouse.
Yes, you're right. Okay. Then see, this is the date, and as I earlier mentioned, only the scope. Yes, you can use what I mentioned earlier. That is something in total required by the standard. You can use IFRS 13 for the valuation of your like assets and liabilities under ISA 90. Okay, so let's move back. Where were we? Okay, Amy acquired Paul 75%. Okay, we can use the solution. See, you can see that here. We can use the solution here. Here you can see that Amy acquired 75% of the Paul and Paul acquired 65% of the alpha. So for alpha, Amy holds 49%. This is the effective shareholding of Amy, and that's why non-controlling interest will become 51%. As you can see from here, non-controlling interest will become 51% in case of alpha, 51.25%. Now we can have a short break, then we will resume our session. Actually, for the rest of the material, because things were very complex, so I have included very detailed discussion from my book in the notes. So we will be going through that material. Otherwise, even a single question can take 2 hours. Okay, so we can have a break. Okay.
Unmuted now. Share.
Okay, welcome back. We were discussing.
You have turned on the camera, which you were not supposed to turn on. I have told you because I was sharing it from my side.
Okay, so do whatever you want to do. Okay, this is a small illustration for D-shaped groups. So here you can see that P company acquired 70% and 40% ordinary shares in S and SS company respectively. S company acquired 30% ordinary share of SS company. All shares were acquired on 31st December 2004 and amounted to 200. Yes. And those of SS company amounted to 200. So here you can see that. So this is a D-shaped group. Here P has direct of 40% in SS and indirect investment of 21%. So this will give P 21% effective shareholding and in total shareholding 61%. And that's why NCI will be the difference, 39%. So here you can see that NCI is 39%. So these are the D-shaped group. We have discussed that then piecemeal acquisition mean where you acquired a subsidiary in pieces, like you might have initially like 10% and thereafter you purchased 45%, and likewise you might have like 15% of a company and thereafter you acquired shares to the extent that that organization will become your subsidiary. So this is piecemeal acquisitions, from simple investment to subsidiary, and from investment in associate to subsidiary, or when you increase your percentage in already existing subsidiary. So controlling interest in a subsidiary is increased. So here, if you come here, so I have included here some small illustrations which explains, like in piecemeal acquisition, what should be done in piecemeal acquisition. Like the principle is very simple. What should be done in piecemeal acquisition? If I just state that principle for you people, then the principle is, in case of simple investment to subsidiary and investment in associate to subsidiary, both are treated as if they were disposed of at their fair value and reacquired at fair value. I repeat again, in these two cases, the principle is, at the date of achieving control, assume that you disposed of the existing shareholding at fair value. Sorry, you disposed of and reacquired it at fair value. For example, you have here like you have here say 10%, and subsequently you have here 10%, and subsequently you acquired like 40%. At the time you acquired this 40%, assume that this 10% was disposed of at fair value and reacquired at fair value. So any gain or loss will go to the profit and loss account. The previously held interest at fair value together with any consideration transferred is the cost of consideration which we used as a value of investment in the calculation of goodwill. When control is achieved, following steps should be followed. Okay, what are those steps? Remeasure the previously held, we shall be remeasuring 10%. Remeasure 10%. Recognize any gain or loss in the profit and loss, and this remeasured 10% will become part of the consideration. So calculate the goodwill and non-controlling interest. If there has been a remeasurement of any previously held equity interest that was recognized in other comprehensive income, any changes in the value recognized in earlier years are now reclassified from equity to profit or loss. Okay, in third case, which is controlling interest in a subsidiary is increased, this is only an adjustment to the parent's equity, and the event is treated as a transaction between owners. Goodwill is not recalculated. So these are the basic principles, and these principles are explained with the help of this illustration, where I have included the solution, where you can see that you acquired a subsidiary. Initially you have 20% and then you acquired it further. Okay, so this is the solution for that. Now come to the disposal. See, under disposal, there are two situations. You have a subsidiary, and there could be two main situations. One, you disposed of your shareholding, but control is not lost. Like if NCI is increased by 20%, as I mentioned, like your subsidiary is at 80% and you disposed of 20%, this means NCI is increased by 20%. So 20% will be here. Net assets at the date of change of that subsidiary and plus unimpaired goodwill of the subsidiary. This will give you this figure. This, by adding these two figures, you will be able to calculate increase decrease to parent's equity. This increases or decreases good retained earning and do not go through group profit or loss for the year. Disposal where control is not lost. Partial goodwill method at acquisition. If you have used partial goodwill method, then this will be the formula. Formula is self-explanatory. It is devised after practicing for many years. Disposal where control is lost. There could be three possible situations. Full disposal where all the holding is sold, subsidiary to associate, subsidiary to simple investment. So there could be three possible situations. On disposal of a controlling interest, any retained interest, either an associate or trade investment, is measured at fair value on the date that control is lost. This fair value is used in the calculation of the gain or loss on disposal and also become the carrying amount for subsequent accounting for the retained interest. Okay, so I have included a very comprehensive illustration which explains how you can calculate increase in equity in case of disposal where control is not lost, cash proceeds, and then percentage increase in NCI, and this is giving you the increase in NCI, and this is giving you the whole answer here. And then there is another illustration too, where you can understand it in a different way. Sale of 5% of Watson share. Again, increase in equity is calculated and decrease in equity is calculated. Then this illustration number 3, in fact, will explain it further, whereby a company holding 100% and it sold 40%. There are 3 small illustrations which will help you in understanding the basic concept where control is not lost. Solutions are provided along with it, but where full disposal, so here you can see that I have written all the steps. Like this was your subsidiary and you disposed of it and now you have cash with you, money with you. So these are the steps which will be used for the calculation of profit or loss on disposal and how it will affect the profit and loss and how it will affect the statement of financial position. Similarly, when you will dispose of partly, mean previously it was subsidiary, now it has become associate, so this will be the situation. Like subsidiary, a bigger car, and then you have a smaller car plus cash. So A point tells you how you can calculate the gain or loss on disposal, and the B and C points will tell you how your profit and loss account and balance sheet will be affected. Similarly, subsidiary to simple investment. So these are the steps which will be followed. And this illustration number 5 practically explain all these 3 situations. So I'll be sending you the answer for this last illustration also. So what we can do, you remember we are conducting these sessions from last 3 years. We have never discussed consolidation. This was the first time we discussed the consolidation. However, from this session, we realized that this session requires approximately 3 to 6 hours more. But no problem, because we discussed at length the basics. For the rest of the concepts, I'm going to give you the material along with the solution. Like as I have shown you, like you can see that all detail is given, and this is extracted from my book on IFRS application. Read through this material, which we could not discuss at length just because of the shortage of time. Do the illustrations, solutions will be available. Feel free to ask me through email, or if you are here in Pakistan, through mobile, by using mobile, any question if you have. You already know my email address is abubakar@miq.com, and phone number is 0321. If you are in Pakistan, you can, but I would request you people to do these illustration first. So whenever you ask any question, that should be very specific. Like you can discuss like things like this. Okay, I was thinking that control should have been achieved on this date. Why control is achieving on this date? I calculated effective shareholding this much. Why it is solution is showing this much? Then like these things. Like so now. Thank you very much. From
some of our attendees have intimated that they have emailed you they have emailed their queries at your email.
This morning I checked my email. Maybe they have sent it after like 11 o'clock.
During the session, I think.
Okay. If you are sending me during the session, of course, tomorrow morning or day after tomorrow, I will be able to, when I go to the office, I mean, this is my routine. I normally check my email normally in the morning at the start of my work. So if you have sent any email to me, definitely, inshallah, I'll be responding to that. For few of respected members, they have sent me an email. I think so. One of them requires a detailed answer, so that's why I included that in my things to do. Whenever I'll be having a time, I'll be replying to that email. If your email is short and to the point, so it will be very easy for me to quickly answer that. But if you have given a detailed scenario and a number of questions within that email, that will be answered. But please allow me some days before I answer that, because I have other demanding commitment as well. But I cannot ignore you people, because we are from the same community. We are one wherever we are living, because we are accountant, in fact. So I respect my community, and I would love to respond to you people. But where you answer, where you require from me like some specific answer on a lengthy scenario, so please minority into market value of those shares at the date of acquisition. That will give us the fair value of the NCI at the date of acquisition. So far as the fair value of the subsidiary and net asset of the subsidiary is concerned, that is basically the fair value of the assets and the liabilities within the subsidiaries.
I think no more questions are there.
Okay, thank you very much from my side, and please feel free to write me if you have any other question. I would love to answer you people. And
we have an announcement over here. We have uploaded all the webinars videos on YouTube channel. Soon they will be available to you on Vimeo as well, but in the coming week, because Saturday, Sundays are off at ACCA. We are working on it, and soon they will be available to all the respective members. So I hope you guys can reach out there and see all the webinars relevant to you, or from where you want to get some sort of knowledge and relevant information. All the webinars are uploaded that have been telecasted or broadcasted to you. The remaining webinars will be uploaded when they will be broadcasted. So if you guys have any queries, the trainer have already told you that you guys have to send your queries to his personal email or at his phone number. Where a person cannot reach him personally at his phone number, he can follow him through his email ID. So guys, have a nice weekend from my side and from SCC as well. Thank you so much for participation and attending our sessions and making it valuable. Thank you so much.
okay, Allah Hafiz from my side. Thank you very much.